Welcome to Talk Tickers. Today, we're diving straight into the recent ConocoPhillips earnings call.
That's right.
Our mission, really to pull out those crucial insights, the key financial details you need to understand where this energy giant stands, and where it might be headed.
And hopefully save you some time waiting through the entire call yourself.
Exactly. So let's start with the highlights. What jumped out from the first quarter results?
Well, ConocoPhillips definitely reported strong operational execution for Q1 2025. Production actually came in above the high end of their own guidance.
Oh, interesting. Above the high end.
Yeah. And adjusted earnings per share were solid at $2.90. Cash flow from operations, pretty robust too, hitting $5.5 billion.
And what about shareholder returns? They usually focus on that.
They certainly did. They returned $2.5 billion through buybacks and dividends. That works out to about 45% of their cash flow from operations for the quarter.
Okay, 45%. That's a significant chunk. Any changes to the full year outlook based on Q1?
Their year-end production guidance is holding steady. They're still expecting, low single-digit growth overall.
Right.
But, and this is interesting, they've actually reduced their full-year capital expenditure guidance, cut it by about $500 million.
$500 million less in spending while keeping production guidance the same.
Exactly. And they also lowered their operating cost guidance by $200 million.
Okay, so finding efficiency somewhere.
Seems like it.
Yeah.
One small flag, though they do anticipate a slightly higher full-year effective corporate tax rate. They put that down to the geographic mix of their income.
Got it. Anything else on the financial side?
Just a quick note on APLNG distributions. That's Australia Pacific LNG. They now expect $800 million for the full year, with the remaining $600 million anticipated to land in the third quarter.
Okay, so it's a solid quarter operationally, beating on production, but also tightening the belt on spending. That's quite a combination. What's the thinking there, given the current, economic climate?
Yeah, management did talk about the near-term macro picture. They acknowledged the uncertainties, things like potentially slower global economic growth, maybe a softer outlook for oil demand.
And the OPEC Plus situation.
Right. The planned unwinding of those voluntary cuts adds another variable. But ConocoPhillips seems pretty confident in their position.
How so?
They really emphasize their portfolio, deep, durable, diverse, they called it. And critically, a low cost of supply. A lot of their inventory has a WTI cost of supply below $40 a barrel.
Below $40, that gives them a lot of cushion.
It does. They see that low-cost structure as a key strength, especially, if things get choppy.
Now, you mentioned efficiencies, the Marathon oil integration that keeps popping up. It sounds like that's going well, really well.
It really does. Progress seems ahead of schedule, and it's directly feeding into those guidance changes we mentioned.
The lower CapEx and OPEX.
Exactly. That updated guidance reflects about $500 million less in capital spending and $200 million less in operating costs, all while holding production steady. That's largely thanks to the integration.
Wow. Are they quantifying the total benefit they expect?
They are. They've actually upped their expectation for total synergies from the Marathon deal now to $1 billion.
$1 billion in synergies.
Yep. And they said over half of that, more than $500 million, is already being delivered through capital synergies.
Already. That's fast work.
It is. They even highlighted a record drilling performance down on the Eagle Ford. They directly credited that to combining the best practices from both ConocoPhillips and the legacy Marathon teams.
So real operational benefits, not just financial shuffling.
Seems that way. And there's a tax benefit too. They expect about $1 billion in tax benefits related to the transaction structure.
Okay, so this integration is a pretty major driver right now.
Absolutely. The speed and size of these synergies, it suggests they could potentially beat expectations, especially on profitability in the coming quarters. It really seems to be a core part of their current story.
With all this efficiency and cash flow, how does that translate into their capital allocation strategy? You mentioned the 45% return earlier.
Yeah, that remains a key principle for them. Returning a significant slice of cash flow to shareholders, aiming for that 45% of annual CFO mark consistently.
And they'll stick to that even if the macro environment gets tougher.
They indicated they're prepared to use cash off the balance sheet to support those returns if they need to. So a strong commitment there.
Okay.
Although they did signal a slight dip in share repurchases for Q2 compared to Q1, that probably just reflects a bit of caution given the broader economic outlook.
Makes sense. So prioritizing returns, but maybe moderating the buyback pace slightly in the near term?
That seems to be the message. It really speaks to their confidence in the underlying business, though, that they're holding that 45% target.
Beyond the big marathon integration, are they still focused on just, the fundamentals, basic cost structure, efficiency across the board?
Oh, definitely. There's a clear ongoing push for cost management. They talked about benchmarking their performance, constantly looking for ways to streamline operations, optimize costs everywhere.
And the lower OPEC guidance reflects that.
Exactly. That's a tangible result of those efforts. And they expect that focus on cost optimization to just, well, continue.
Okay, let's swing back to production. Holding the full year guidance, low single-digit growth. What about the immediate next quarter, Q2?
For the second quarter, they're guiding production to be between 2.34 and 2.38 million barrels of oil equivalent per day.
2.34 to 2.38 million.
Okay, yeah. And that number includes an expected impact of about 40,000 barrels a day from planned turnarounds, maintenance work, mostly in Norway and Qatar.
Got it. So underlying production is strong, just some planned downtime.
That's the picture. And it's also worth remembering they expect capital spending to drop off quite a bit in the second half of the year compared to the first half.
Right, less spending later in the year. Now, looking further out, what about those big long cycle projects? Willow in Alaska, their LNG stuff, how are those progressing?
Good question. The Willow project that remains on track for first oil targeted in 2029.
Still 2029.
Still 2029. They hit key milestones over the winter construction season. Things like getting roughly half the civil works done, making significant progress installing pipelines.
So boots on the ground, work getting done.
Yeah, and the engineering and fabrication for the processing modules, that's also moving along as planned.
And the spending profile for those?
Peak capital for those big projects, like Willow and the LNG investments, was expected really in the first 3 or 4 months of this year, 2025. So spending should gradually taper off to the rest of the year.
Okay, so heavy investment now, paving the way for future production. That must impact their current profitability metrics, right? Like break even.
It absolutely does. Right now, their free cash flow break even point is sitting in the mid $40 per barrel.
Mid 40s WTI.
Correct. And it's important, to remember that includes their dividend payout that adds about $10 to the break even figure.
Okay.
But critically, that mid $40 number also includes all that heavy pre-production capital spending for Willow and the other big projects we just talked about.
So that's weighing on the current break even. Where do they see it going once those projects are up and running?
That's the key. As those projects come online and that pre-productive capex rolls off, they anticipate their free cash flow break even will drop substantially down into the low $30 per barrel.
Low 30s. That's a huge difference.
It really is. It gives them a much, much larger buffer against oil price swings. It means they can be very profitable even if prices pull back quite a bit.
So despite maybe some near-term economic jitters, the big picture sounds like long-term confidence driven by efficiency and these future projects.
That's definitely the impression they gave. Strong confidence in their resource base, especially lower 48, emphasizing that low-cost nature.
Right.
Their strategy remains focused squarely on returns on capital, returns of capital. Production growth is seen more as like an output of doing that well, not the primary goal itself.
Disciplined growth.
Exactly. And they see a really compelling long-term path for free cash flow growth because of this strategy and project pipeline. They're still looking to add low-cost resources too when the right opportunities come along.
Okay, that paints a pretty clear picture. Let's shift gears then into our This Is Not Financial Advice segment. Based on all this, what's an outrageous but plausible trade idea that springs to mind?
Okay, outrageous but plausible, I like it. Here's one thought. Given how well the Marathon integration seems to be going, maybe even faster than expected, and that higher $1 billion synergy target,
Yeah.
you could consider a long position in ConocoPhillips itself, but here's the twist to make it, outrageous but plausible.
Go on.
Pair that long cop position with shorting a basket of smaller, maybe less diversified E&P companies, the ones that probably lack the scale or the integration benefits to achieve similar cost savings in this environment.
So betting on ConocoPhillips' execution strength relative to smaller players.
Exactly. Leveraging their demonstrated ability to integrate and cut costs, potentially allowing them to outperform those less agile peers, especially as those Marathon synergies keep flowing through.
Interesting. Okay, I've got one too, maybe looking a bit further out.
Right, let's hear it.
With Willow hitting those milestones, still looking good for 2029 first oil, what about a long-dated call option on ConocoPhillips?
Playing the long game.
Yeah, it's definitely a more speculative, right? But it's a bet on that significant jump in free cash flow they expect once Willow and potentially other major projects are actually producing.
So you're betting the market hasn't fully priced in that future cash flow stream yet?
Pretty much. The idea is that as 2029 gets closer and the market gets more comfortable with that future cash flow potential, the stock's valuation could re-rate higher to reflect it. So the call option captures that potential upside.
That's another interesting angle. Definitely requires patience, that one.
For sure. Two different ways to think about it, playing different aspects of the story.
Definitely plausible, if a bit outrageous.
And that wraps up our deep dive into the ConocoPhillips first quarter earnings call. We've hit the key results, the strategic moves like the Marathon integration, their outlook, costs, and this couple of trade ideas for you to chew on.
And just to reiterate, this isn't financial advice, just sharing insights and potential ways to think about the information.
Absolutely. We hope this gives you a clearer picture of where ConocoPhillips is today and maybe where they're headed. What stood out most to you? Do you have lingering questions? Definitely do your own research and analysis.
That's always the best approach.
Join us next time on Talk Tickers for another in-depth earnings call breakdown.